Will we ever go down again? That's the big question after an unprecedented start with 3 new all-time highs in the S&P 500 with as big a moves as they were these past 3 days. We're not talking about little piddly bullish moves higher, which is typical for bullish trends. We've had some decent ranges and decent volumes. How does that impact this bullish move and the expectations of more near-term volatility that we've been looking for? Is this part of that? Does this get us out of that and now start a new bullish? So I'm going to break all that down in today's market outlook video. I'm also going to with today's trade idea, take a look at a stock that looks like it's trying to break through resistance. So how can we trade it if it does or if it doesn't? So let's go ahead and get started. Today is Thursday, January the 4th, 2018. This is the market outlook from Market Scholars. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Keep coming back for more. Subscribe to my YouTube channel by clicking that red subscribe button right down there below the video. You can do that right now while you're watching. Also, click that thumbs up icon right next to it. That lets me know that you liked today's video, that you want me to do again tomorrow. Really easy way to give me feedback. Let me know what you're thinking. Scroll down further, comment on anything that stands out to you from today's video. Anything that you picked up, that you take away, and that you can use. I love to hear what you're getting out of it. Finally, you can see in the video description, there's a bunch of links down there. Subscribe to my daily email Market Outlook newsletter with that link that's in that description below, so you can get these time-stamped summaries, hyperlinked summaries of everything we talk about in these videos day in and day out. Follow me on Twitter for more content in addition to these videos. You see my handle up there on the screen at DavidSettle42. Always pinned to the top of my timeline is tonight's Market Outlook tweet. Like and retweet it from there. The more you do that, the more Twitter will keep pushing you my tweets with all the other accounts that you got. Finally, you can join the Market Outlook Facebook community by clicking on that. You see the address at the top of the screen here, but also there's a link in the description of this YouTube video down below. Just click that link, takes you straight there. There's 750 of us now in the community, so click and join us. The more the merrier. All right, well, let's take a look at the S&P 500 with the market forecast indicator. You can see the near-term lines entrenched in that upper reversal zone for another day up above the 90th percentile. As well as the intermediate line. So still a strong bullish posture. I have to move this this up a little bit higher now. You can see we've really kind of broken out here in the last 3 days. In fact, again, one of the best starts that we've had in 2018 to the beginning of the year. 3 all-time highs in the S&P 500 with as big a gains as they are is practically unprecedented. So good movement, again, a move in the direction of the trend, so that can happen. Not expected, at least not that much of a move this fast, wasn't expected, and that's why it's gone up so much, so fast. Usually, if it's expected, you'll see it kind of gradually move up higher, and people start pricing it in, but it moved up pretty far, pretty fast. In fact, you can kind of see how, we've had this pretty steep line. You could say something like this. If you were to draw a trend line like this, we've got a good little trend going on. Then we've got, this kind of slower trend going on here. And then, of course, and now we're going, parabolic off of that move. And so, that can happen when you have trends. We've been going along, we're speeding up, and we're speeding up even faster now. And of course, the momentum lines drop because today's move wasn't as big unless you account for the gap, which we will here on another chart. So that's why the momentum line dropped. Market sentiment still up above 80. So still bullish outlook here. And again, not expected to be, a full 7 to 12 days, even though we are now, let's see, we're 3 days. Let's see, no, this one was still at 49 too. 2 days up above 50 for the near-term line. Those 2 days also happen to be above 90, but you've got 2 days above 50 there. Again, just like these moves here, this one and this one, and even that one too. These peaks that you see, these red ovals here, I don't expect. That one only lasted a few days. This one lasted 2 days. That lasted only a couple of days. That's kind of more the expectation for how long that's going to last. I don't expect it to last something like this, or even, especially like this, this long. Again, simply because we are 4 months into this intermediate trend. So things are looking good for current positions and for some newer positions. But for, if we're going to really enter some decently normal sized new positions, then we need that intermediate pullback. And that's why I've got the lines drawn here. This is the intermediate Fibonacci pullback retracement levels. The orange is the market sentiment. Last time market sentiment got below 50, which was at the election pretty much. So and you can see the 23% Fibonacci retracement, which is all we came back to the last time we pulled back on a market sentiment level, right at pretty much at the election. We pulled down to the 23% Fibonacci retracement level. You see that happens to line up with this current, with the 50% retracement of the current intermediate run. So, and you can see the 38% happens to line up with that old high point. So you can see how these line up together, and the 100% lines up with the 50% down to 2,400. Of course, that would be a significantly large move if you were to fall 300 and some odd points from here. Well, more than 10%, and we haven't got a 10% drop in the past couple of years. So I don't expect a 10% drop on this next pullback. Usually we already are on a bearish trend before you get those bigger drops. But I wouldn't be surprised if we get a drop down to around this 2,600 or maybe a little bit lower if and when we do finally get the pullback. But again, it's most likely going to be very grinding and maybe even potentially not even getting that far. The first intermediate drop, it might take a kind of a false bullish move to produce that enough of an intermediate trend to get us down to that 2,600 level. I know that sounds crazy, but the market's just so bullish right now. You never go from strongly bullish to strongly bearish. You can actually go from strongly bearish to strongly bullish really quickly because volatility is higher. The VIX is usually higher when you're strongly bearish. When you're strongly bullish, the VIX is historically low, and so it's rare that you'll ever go from strongly bullish to strongly bearish quickly. It usually takes a while for that VIX to kind of grind and start to move its way higher. The Dow shows a similar pattern in its market forecast to the S&P 500. You look at the NASDAQ composite, very similar as well. Strong bullish postures, strong short-term sentiment, but falling momentum lines simply because of the smaller ranges after the strong range on the first day of the year, followed by a couple smaller ones. You notice we're still on the Russell. We're doing pretty well, and we've gotten above this 1550 level, still holding below on a closing basis the high of that long upper shadow, which I've told you before can act as a resistance level. Despite that, still got strong bullish posture, strong short-term sentiment. Again, don't expect short-term sentiment to last a typical length simply because the intermediate run is so long in the tooth. So we'll take a look at the long-term chart, and you can see on an absolute basis that we are farther up above the 200-day, the 50-day moving average is farther above the 200-day moving average than it's ever been. I mean, we're at 136 points. That's the blue line here being up above. But again, that's on an absolute basis. On a relative basis, we're getting closer to this the end of 2013, 2014 level. You can see. If I were to get my calculator out here and then get to that highest point, which was about 104 points, 104 and a quarter points, out of, at the time, the price on that week was 1842. So we're looking at 5 2/3%, and right now the current level is 136 points. Divided by the current price of 27.24, we're still just about at 5%. So the MACD still has a ways to go before it reaches that extreme peak that the 50-day got above the 200-day moving average. And you can see that was 2013, fueled by QE. We never touched the 200-day moving average that whole time. We did start to get some volatility. You can see we only had 2 sets of arrows in 2013. Coincidentally, we only had 2 sets of arrows in 2017. We started to get more sets of arrows in 2014, even though we still rallied. We did have a touch of the 200-day moving average. This is what I expect to see in 2018. Still an upward move and still pretty decent return potential, but more volatility, more touches, more crosses below the 50-day moving average. And you can see that happen. We crossed below the 50-day moving average pretty soon after we got that extreme high point for the 50 being above the 200-day moving average. Now, I do want to show you this really quick. You take a look at the current, look at the MACD here. Compare the current price to the 50-day moving average, and you can see we are way up above it. Hit OK here. The last time we've been this far up above it was the end of 2016, right about in this area here. Zoom in. So right on that week, on that large candle right there, you can see that did not spike. If you look at it from the context here, it was a big move off the 200-day moving average. It did not cause a pullback, but it did produce, 1, 2, 3, 4 out of 6 down weeks. It wasn't a down period. It actually went up over that 6-week period, but again, produced some volatility, brought the level closer to its 50-day moving average before popping back up here and then producing a little bit of a divergence and a little bit more of a pullback here. So, again, that's the last time we were this far up above the 50-day moving average. And the week's not really even over yet. Remember, we have one more day after the jobs report tomorrow. Looking at the 3 green arrows, again, obviously way up above the 8-day moving average. You can see, the MACD cross back up above here, setting up for a potential divergence pattern that we still also have the potential for in the stochastics. We were already looking for that divergence on the stochastics, and now setting up that possibility on the MACD as well, unless we really continue to push higher and keep that positive momentum up to higher levels. Just to kind of give you an idea how likely that is, we'll take a look at the current price, the MACD of the current price relative to the 8-day moving average, because we usually don't get so far up above that one. Oops. Try that again. Current price, 8-day moving average. Oops. There we go. So again, 25 points up above. So last time we were this far up above was right here in mid-December, and you can see that produced a little bit of a pullback throughout the holiday. We were also this far up above at the end of November, right there, and it produced that move to get back to the 8-day moving average. So we don't typically get this far away. Here's another example here. We got that far up above the 200-day moving average, coming off of an intermediate low point. So a little different now. These others were similar to what we see here. We're on a mature intermediate trend. We were just starting an intermediate trend right there. And you can see the volatility didn't come sharply down, but it produced some down days and caught back up to the 8-day moving average, produced some divergences there. And then finally, you can see the last one here, March. We've talked about that day ad nauseum because of, again, that was the last day, last push off the 8-day moving average at the end of the 4th month of an intermediate run, which is similar to what we got now, an extra month longer than what you would expect on an intermediate posture. You can see the big gap on the intraday chart, getting all the way up to 272, and this is coming off of finishing the year below 267, so a 5-point move. And keep in mind the range for the 2-week period is 10 points. So we've essentially gone from the halfway point. Remember, we've been moving up the low point here, and we'll start gradually moving it up every day until we get it up to that low from the 14th. Which will make this about an 8.5-point move. And of course, after about another week and a half, by the end of by a couple weeks from now, we'll move it up to that low point, last week's low point that we had on Friday, on the last day of the year. So, and of course, that will be us about a 5-point range for the current range here. But you can see that 5-point range came in the last 3 days of a 20-day period, 4-week period. So we've gained half of our 4-week range in the last three days, which means, again, don't expect any strong bearish moves anytime soon. As long as we're trading in this half of the 4-week range, there'll be a slight bullish bias, and any pullbacks will be moderate. Once you break below into this half, then the pullbacks will start to pick up a little bit. Nothing too big of a deal until you break through that low point there. And of course, by the time that happens, that low point won't be there anymore. It'll most likely be here, or by that time up in here. If you take a look at today's total range, and remember, we have to account for the gap. So we closed at 240.5 yesterday. The low today, 270.5. So we filled in the gap, and you can see the range today, 1 2/3 points, volume at 81 million. So put that in context here. 81 million, still high end of the range, of the 52-week range, not bullish. I mean, that's bullish days, of course, but it's hard to sustain that big of a range and that much volume. So 1 2/3 points up here above the average. Those are bearish ranges when they're this high. You want them to be down here, 60 million shares, trading hands or less, 1 point range or less. That is a sustainable, that's a sustainable kind of move. The more volatile it is up, then the more volatile it will be coming down. And remember, we're expecting more near-term volatility, which means more near-term ups and downs that we're getting here. And then finally, looking at the VIX, we'll take a look at the VIX. You can see it's trading right at that 9. Can't quite get below 9. It is a little bit getting below 9, and we've done that before. But, obviously not breaking significantly below 9, holding it for support. That's a major level for volatility. That is on an absolute basis, and of course, on a relative basis here, you can see volatility still is an extreme low at 75%, which we don't really get 2 consecutive days at 75%. We did in November, at the beginning of November here on the 5th and the 6th. And you can see volatility ramped up after that. In fact, if we go back to the volatility index here, here is that right there. When we had a couple of days in a row here, what would be the 3rd and the 6th, couple of days of really extremely low volatility, and then we made a run up to 13, from 9 to 13 in the matter of a week and a half. And what did that look like on the actual index itself? So here's the 5th, the 3rd, and the 6th right there. And then over that next week and a half, we had to pull back down to the 30-day moving average. So again, that's the situation that we're in right now from a volatility perspective. And you add that to the fact that we're so far up above the 30-day moving average, something similar may be likely here, if not tomorrow, next week. All right, now let's transition into what's driving the price action today. And before I get started here, I wanted to point out on the Facebook page, I know a lot of you, I put a poll out there in our community group about whether you prefer me to post content on Twitter, just on Twitter, or if you want me to also post the same stuff I'm putting here on Facebook. And I got a lot of responses to put it on Facebook. Put it on Facebook. A lot of you use that. I wanted to make sure you knew about my Facebook page. And again, it's just you search for David Settle Market Scholars. You'll find my Facebook page there. Make sure you like that page. You'll see a button that will say here to like this page right there. You'll also see a button here at the top right corner to visit the group, the Market Community Group, Market Outlook Community. You can see it's also down here too. That will take you to the community group where you can join the group there. There's about 700 some odd people that have liked this page, and about almost 750 in that group. You see my email address and the website here as well. There's a place up here to leave a review for those of you who have used me before, or just want to let the world know about why you like this page and what you get out of these videos, and any education you might have received from me when I was a coach at my former employer. And that's where you can leave the reviews there. I appreciate those that already have left reviews. Over here on the left, you'll see a bunch of different links. There's that reviews link as well. You can also post on the group too. You can see you can write something and post it on the page. There's also a link to the YouTube. So that can take you right to the YouTube spot and watch the video from there, the most up-to-date video. And of course, you can also see the stuff I put on Twitter. there too, and all the different posts. So I might not get everything from Twitter on the Facebook, but I try to do as much as I can. And then if, of course, just looking at that link there, and there's a fan of the week tab, and what that essentially does is we'll see, okay, who's liking them over the past week, who's liking and commenting and sharing more of the content. And just to kind of give you an idea here, let me go back to my page, my view of this. So the most recent Market Outlook post, remember there's 700 some odd people that follow this group or have liked this page, but you notice that the post only got to 460 people. And again, Facebook is even worse than Twitter and not getting you every single post that anybody you follow on Facebook puts out there. Otherwise, you'd just be flooded with stuff. So what it tries to do, it tries to promote to you the posts and the content that you engage with the most. So the more you are liking it here as well as on Twitter, and you share it and comment and things like that, but especially the more you like it, the more Facebook will say, okay. And also the other thing too, business pages like this really get low priority. So you might not ever see anything I post from my Facebook page in your timeline, because number one, it's a page. Number two, you might not have liked it recently. So the more you like on it, the more it will lift, start to prioritize my posts within your timeline to make sure you're always getting my stuff. And the more you do that, you might one of these weeks be the fan of the week. All right. So let's take a look at what's going on here from a calendar perspective. You can see let's take a look at the calendar first. The big thing that came out today was the ADP report coming in much better than expected. It was expected to be a little bit of a drop. It was revised lower, but then the number, this week's number, is one of the highest that we've had. And that's a strong number for being as mature into this jobs growth cycle that we're in. I mean, we're obviously years into this jobs growth cycle. So very strong number, and what that did was it really jumped up the odds for a rate hike in March, as you saw there, to 73%. So there's the odds of one rate hike, there's the odds of no rate hikes, and then the gray one is 2. Obviously, we're not going to get 2 by March, but the odds of getting 1 are up over 70% now. And then we'll take a look at June. Remember, 150 to 175 is 1. Take a look at it here. Here we go. So 150 to 175, you notice the odds of that are going down in June. Why? Because the odds of getting a second hike by June is higher. So that will, because we're not going to go back down. We're not going to stay at 150.75. So, and of course, 125 is going down to hardly anything. And then you can see by September, so now we're looking at a third rate hike potential. And you can see that's this dark blue line. It is higher than only getting 1 by next September. So you can see the odds of more and more rate hikes, 1 in March, 1 in June, 1 in September, are rising higher, mainly because of how strong economic indicators continue to be here. Now, one thing I tweeted out today, and I wanted to point this out, because I heard this on TV, and I don't know how many of you saw these tweets, but I wanted to kind of explain these tweets here. The CAPE ratio is obviously extremely high. We've only been above 30. We got to 30 at the end of 1929. Of course, that sparked Great Depression, and for a multitude of factors, not just the high Shiller PE ratio, which is basically a 10-year. The P is the current price, and the E is earnings, right? PE, earnings. But this earnings, instead of the last 12 months or a forward 12 months estimates, it is it's a yearly average of the last 10 years. So it looks at all 10 years earnings and averages them out. So it's 1 year's average of the last 10 years, and it's adjusted for inflation as inflation changes over the course of that 10-year period. So it kind of gives it a real level. So that's what the E is. And again, we were above 30 in 99 and 97 actually, and that's what I pointed out here. We got above 30 in 97. So Jeremy Siegel, which is actually a pretty good friend of Robert Shiller, says that this is giving false signals. Well, what is a signal? What is the CAPE signal? The CAPE doesn't signal, the fact that it's above 30 doesn't tell you should sell, because oh, well, last time it was, we got all the way up to 45, and that was the big tech bubble bursting and the Great Depression. It's like, no, we don't sell when it gets above 30. What we do is we lower our return expectations. So for an example, once it got to 30 in June of 97, 1 year later, the stock market was up 28%. From June to June, 28% return. Obviously, it was not a sell signal. And 2 more years later, by the time the S&P peaked in August of 2000, the S&P was up 18.5% per year. 18.5% for over 3 years, average return. Obviously not a sell signal. But the 10 years from June 97 to June 07, 5% a year. Even though the first 3 years plus had an average of 18.5% per year return, by the time it was 10 years old, it had dropped all the way down to only 5% a year. Only 5% a year versus, and this is all on a cash basis, so no dividends, versus 8% a year that it had averaged over the 30 years heading into June 97. So the S&P was up 8% per year on average, purely cash, no dividends, 8% per year for 30 years on average. And then, then we get to June 97. So 8% a year, get to June 97. The next 12 months, 28%. Boom. The next 3, and that year plus 2 more years, 18.5%. The market's going crazy. But 10 years from June 97, only 5%. Despite those big numbers, finished only 5%. So smaller returns than what it had averaged going into it. That's what CAPE tells you. So yes, CAPE is up to 33 right now. And yes, the market's been going crazy since it's crossed above 30. That doesn't mean that we're selling right now. And as I've talked about before, expectations for 2018 are we're going to have a decent year. I expect to have a decent year. More volatility, but still a decent year by the time it's all said and done. But over the next 10 years, so when he says that, it's giving false signals, well, you don't know it's a false signal until 10 years from now. What's the average return going to be or 10 years from now? And we don't expect it to be as high as it normally is heading into where we're at right now. All right, so I'll get off my CAPE bandwagon there, soapbox, and take a look at what's moving today. And you can see, again, over a 3-day period, crude oil, emerging markets, this weak dollar, long-term bonds dropping. This continues to be the case today. International stocks really whooping up on U.S. stocks, and large cap stocks whooping up on small cap stocks. So it is obviously a weak dollar move, and it's really benefiting these larger cap. Remember how small cap stocks benefited from the tax reform? Well, large cap stocks benefit more from that falling dollar because they have a bigger international presence, whereas tax reform really boosts the small caps because they don't have as much cash. They do more. They will benefit more from those corporate tax cuts. They don't have as much overseas operations where they don't have to pay as much in taxes. And you can see again today's move was largely driven by developed markets. So you can see gold bouncing up today. Again, essentially a weak dollar move, and a weak dollar, as long as the dollar continues to struggle, and it's been on a down. You can see, there's today's move kind of reversing the yesterday's gains, and so far up a little bit today. But we're kind of at these lows, and those aren't like all-time lows. There's more opportunity. If you recall, I've shown you this before, but there's more opportunity for the dollar to go down. If it were to break these lows and break through 90, we're looking at 80, and that's kind of where we got to when we during the last kind of bearish run on the dollar, where we came down from 120. See, we're only coming down from 100. So there's opportunity if this breaks to really continue to move lower, and we're going to know, okay, well, you can see international stocks did very well during that time frame from 02 to 08. International stocks did really well. In fact, you can see it here. There we go. There's EFA compared to SPY, and you can see from 02, a little bit of a pullback in 03, but all the way through to 08, there's the rally that EFA had compared to SPY. So big move when the dollar's dropping. International stocks outperformed. Dollar's been strong, and so the international stocks have really underperformed. So a lot of, you can see an inverse head and shoulders pattern developing. A lot of potential for some outperformance. Make sure that you have international exposure, in your broader portfolio. And then finally, if you just take a look at gold during that same time frame, again, you don't quite get that O2 because GLD, in fact, let's take a look at the futures. Here we go. So there's the futures from O2, middle of O2 to about middle of O8. You can see we went from about, $300 up to $1,000 an ounce. So, once we hit that $1,000, we kind of had some struggle. Then it really took off with all the QE up to 1750, and then it has pulled back. So there's going to be opportunity here for gold to outperform again, similar to the move we had there when the dollar was weak, if the dollar continues to trend lower. Okay, so looking at the 3 days of 2018, again, materials, energy, technology, consumer discretionary, healthcare having a decent run, but you can see today financials had a little bit of a jump. So they started the day higher, pulled back, still finished with an outperformance relative to the S&P 500, but were the outperformers for most of the day. Poor utilities and real estate. They're just really struggling from the they're interest rate sensitive, and they're struggling from the moves higher. And let's take a look at the 10-year note. The 10-year note, you can see continuing to move its way higher and trend higher, and that's going to have a benefit for those financial areas. You can see that this week, when you compare the 90-day T-bill compared to the 10-year Treasury note, it's been down. That yield curve has been flattening and flattening. Is bouncing up a little bit here this week. So obviously this bounce up here from really low levels would be that's what benefits financials more than anything, is when this rallies. So with today's trade idea, I want to look in that financial area, and you can see U.S. Bancorp, one of those stocks in the S&P 500 in the financial sector, coming up off of a new set of higher low point, a new set of 3 green arrows on the 6-week moving average, the MACD and the stochastics down here. Spike in volume, 1.5 times the average volume. So we had a new set of higher green arrows, so a higher low point, kind of holding this 54 area for new support, bouncing off of that. There's earnings coming up, so we need to be aware of that. And the way we are is we just use a smaller position size than normal on a new position. But you can see there's opportunity. At 55 was an area of resistance here. We hit it. We got above it actually, but then formed that bearish engulfing pattern, came down. Tried to get up there, not quite, came down. Got up above it again, formed this shooting star, a couple of shooting star patterns, came right back down. You can see 55 is hard, and it didn't quite get up above it today, but it's trying, and it did this time. See, this move here didn't have the spike in volume. This one also didn't have quite the spike in volume. Today, we did, and we started off really strong, didn't quite make that. So what we're going to do is we're going to say, okay, it looks like it's trying, so we're going to sell the 55 put, but only when the credit, which is currently around 76 cents, drops down to a credit that I'm okay with, where I can get enough return to justify the risk of this high probability strategy. This strategy gives me about a 60% return if the stock gets up to 55.5. So it's got to get up there and kind of stay up there, make sure it holds that close. Then I can use a stop limit order so it gets in automatically. I can just wait and watch this, kind of save this order and watch it and see what it does tomorrow. See if it closes and holds above 55 with good volume again, similar to what we got today. But here's a way to say, okay, here's a stock, it's trying. The sector is looking good. It's been underperforming. A nice little bounce here. This stock is trying to break through a level. It's having a hard time breaking through. Good volume today. Let's see if there's some follow-through. If there's no follow-through, then we don't trade it. And we can actually do it the other way around and do calls instead. Right? We can look for call options and sell and buy the 57.5 and look for a call option instead, right? And do that trade. But if it breaks through and holds it, then we do the puts and we buy the 52.5 on the other side of 55 for that protection to the downside. So kind of a way to do either or, but considering that we have a higher set of 3 green arrows, we're starting to trend higher and good volume on the upside, the expectation is we might use this one. But prepare to use the call options if it fails in the next day or two and we never get the credit. Because see, we won't get that credit unless we continue to move higher and hold up there. So again, to summarize, the market's had a very good start to the year, but it's really far up above some moving averages that expects. And just because we've had this kind of strong 3-day move, unprecedented strong 3-day move, doesn't necessarily mean that the near-term volatility that we've been expecting we don't expect it anymore, right? Near-term volatility means we have ups and downs, and the fact that this was such a big move up kind of confirms that there's going to be volatility. We expect, we'll expect big moves down, not trend changing, but similar to the moves we're getting on the way up here. So that's near-term volatility, ups and downs, ups and downs. We happen to be getting higher ups and higher lows. So that's why we're still kind of bullish, and the posture is still strongly bullish. Market sentiment strongly bullish. We are going to get that pullback at some point. Not a big pullback now. Maybe later, eventually it'll get bigger. But strong bullish trends turn into weak bearish trends. And that's what we're expecting, simply because, again, so far up above. Doesn't necessarily mean that all sectors will go down, and there's an opportunity in today's trade idea for a bullish trade if we get the breakout. If the breakout doesn't occur, then we'll just trade it to the downside with everything else. A weaker downside, right? So again, remember to subscribe, like, and comment on the video down below. Follow me on Twitter for more content. If you're not already doing that, @DavidSettle42 is my Twitter handle. And again, join that Market Outlook community. The link is in the description of this YouTube video down below. Click on that, takes you straight there. Make sure you are engaging with the content on Twitter and especially on Facebook. So that the algorithms at those social media sites will keep pushing you and promoting my content to you so you're not missing it. Have a great evening, everybody. We'll see you all tomorrow.